Will this bold pension move protect our chances of early retirement at our chosen age of 57? Global risks feel unusually high right now. Uncertainty seems to be ruling the world, but this one decision in our pension portfolio could help us navigate the current market turbulence. Stock markets are swinging around up one day and down the next. There's job uncertainty in the US and conflict in the Middle East that could push inflation higher again. So with all of this going on, does increasing our equity position in our pension portfolio really seem like the wise move right now? Sure, if markets had sold off significantly, then increasing equities might make sense, but they're currently sitting within about 5% of all-time highs. So, in our opinion, the risks may outweigh the potential benefits at the moment. We've previously talked about our large cash position and the possibility of increasing our equity allocation. But right now, it just doesn't feel like the right time. What do you think? Earlier this week, we even switched our energy supplier and locked into a really good 13-month fixed deal. And in many ways, that's what this is all about, weighing up the risks and trying to protect against the downside so that we stay on track to retire at 57. So our bold pension move right now is actually quite simple. We're choosing to keep our safer portfolio positioning for the time being. With regular pension contributions still being added, our cash allocation has actually increased slightly compared to our last update. So I'll now show you exactly what our current percentages are and how they have moved from the last portfolio update. Our cash and cash equivalents have now overtaken our developed market equities and become the largest holding. They now represent over 43% of the portfolio, valued at £61,614. Next, we have developed market equities at 42.35%. And then the remaining holdings are much smaller in comparison. Emerging markets at 3.6%, and the three types of bonds combined make up 7.87%. Previously, we were also considering increasing our bond allocation to around 20%. But since the conflict in the Middle East began, we're not quite so sure. Rising oil prices could push up inflation higher again, and rising inflation could push bond prices lower. So that gives us the incentive to stay more focused on the shorter end of the bond market, or, as we have done, overnight rates as per money market funds. Another option would be if we focused on index-linked bonds. Although I've always felt they don't offer particularly good value and you seem to effectively pay a lot for the inflation protection. Now, let's have a look at how the two main assets have performed since the last portfolio update about 6 weeks ago. First, we have the cash and cash equivalents. Over the past 6 weeks, this portion has grown by 0.475%, which might not sound like much, but for cash, that's actually quite impressive and works out at around 4.2% annualized. Now, let's look at the equity side of the portfolio. Once we remove the contributions that we've made during that time, then the underlying performance works out to be a net gain of 1.9%, which annualizes to a mighty 18% per year. So overall, that's our summary of how our pension portfolio has performed over the last 6 weeks. However, this last week, since the start of the conflict in the Middle East, has told a different story. Our overall pension portfolio has dropped from £143,547 down to £142,839. I know that's only a drop of £708 or around 0.5%. And with my huge cash position, I'm perfectly positioned to withstand any falls in equity prices, and indeed would welcome a trimming of the high valuations that we currently have. But even that figure of 0.5% fall isn't the true figure. When you adjust for the pension contributions made at the start of this month and factor in that our cash has grown slightly during the week, then the true figure is a fall of 1.7% in equities. Now, I'm not worried about this in the slightest. I wouldn't reduce my equity position. That's not really my question that I'm asking at the moment. What I'm more interested in is working out if now would be a good time to actually increase our equity or bond allocation. On a technical front, and sorry if this is a bit boring to some people, but one index I've been following is the volatility index, or VIX. Now, when this figure divided by the 3-month VIX has been over 1, then historically it's been a good time to buy US equities. It currently sits above that 1 figure at 1.07. So in theory, I should be starting to dip into equities a bit more. Not massively, just gradually. But if the Middle East conflict grinds on, then inflation could provide a market shock. What are your thoughts? Added to this, we have US job uncertainty with a surprise massive negative figure released on this Friday that's just been, showing job losses that shocked the market. Is the US on the brink of recession? So what do you think of our current asset allocation? Will holding this much cash help protect us during this period of uncertainty? Are we missing out on potential growth? Or do we have the balance about just right? Have we done enough to help lock in our target retirement age of 57 by playing things a little safer? Or are we simply being too cautious? As we've shown in our monthly updates, we don't need a massive amount of growth to maintain this target retirement age of 57. We just need to match inflation. So let me know in the comments what you think. I'd be genuinely interested to hear your thoughts on this. And what do you think about the current geopolitical situation? Do you think the Middle East conflict could push inflation higher and increase uncertainty? Or might things settle down fairly quickly? Thanks for watching, and I'll see you in the next one.